Two major hurricanes and that Boeing strike are having a big impact. The unemployment rate staying just over 4%. Let's get some reaction now from Michael Feroli. He's the chief U.S. economist at JPMorgan. Mike, it's great to see you. And how would you, what for you is the most important signal to separate from all of the noise in today's report?
Well, I mean, you're right. There's a lot of noise in today's report. I think you mentioned the unemployment rate, which held steady, or to higher precision, it edged up a little bit. That probably isn't as influenced by either the strikes or the hurricane. So I think that part of the number and everything basically relating to what we call the household survey is probably a little more reliable. It may have been, just a touch on the soft side, but nothing to get too worried about. So I do think it probably fits in with that, sort of Goldilocks narrative you alluded to earlier, that in conjunction with what we saw earlier this week with job openings and with employment costs, are kind of suggesting a pretty soft landing and, a labor market that's probably coming into balance, but not cooling in a manner that's worrisome so far. So overall, again, a lot of distortions, a lot of squinting you have to do to kind of see what's really in this number. But overall, we think it's still a pretty favorable story.
But in other words, even though we added only 12,000 jobs last month, you think we're not in danger of the economy slowing down precipitously? We're not in danger of seeing now a turn towards layoffs at a mass scale or anything like that?
No, I don't think so. I mean, we know we know pretty well that at least 40,000 of that disappointment was due to strikes, if not more. There probably was some hurricane effect. We'll know in a couple of weeks when we get the geographic data. But certainly what we're seeing in jobless claims, just yesterday, suggests we're not hitting an air pocket in job growth. So that headline number of 12,000. We don't know if it's being held down by 50,000 or by 150,000, but it's almost certainly weaker than the truth out there in terms of actual job growth. So a variety of other indicators would suggest that that's that we can kind of set that put an asterisk next to that and still have a pretty favorable, like I said, pretty favorable view of
the consensus notion is that the Fed will cut interest rates by a quarter point on Wednesday. Is there anything in this report that would change your view of going along with that consensus?
No. Look, I think before the Fed went into their blackout period this week, what they were saying was pretty consistent with a cut next week of 25 basis points. It's actually on Thursday. And then most of the data we saw this week, again, not only today's report, but also earlier what we saw with job openings, what we saw with the employment cost numbers. I think that's all consistent with as they've been pointing out, inflation's come down quite a bit. The labor market's coming into better balance with perhaps still a little smidge of a downside risk to labor markets. So in that environment, maybe we think it still makes sense to get back closer to neutral, which is the way the Fed's been talking about it before they went quiet, and so we have no reason to think what we saw this week should change their opinion in that regard.
Mike, what do you think about the Fed now? We're pretty much fully priced in for a quarter point cut. Jim Bianco last hour said it's unnecessary, kind of because of these comments about how the economy's doing, and look at stocks at all-time highs. Do you think they'll go a quarter? Do you think they'll keep going a quarter?
So I think they'll go a quarter next week, as we discussed. I think they probably go another quarter in December. I think as we get out into next year, they may step down the pace, in part because we would be getting back closer to neutral, and also we'll probably have more uncertainties. We could have more uncertainties in terms of fiscal policy and other things that may cause them to be a little more cautious. But for now, I think continuing to modestly correct policy back toward neutral makes sense. But I think in part, some of the financial conditions you mentioned are reflecting some of the things the Fed is seeing, which is that some of the adverse supply shocks, which were driving inflation higher, are receding. So it makes sense in that environment that, risky assets would do well, and that also that the Fed would be, getting back on sides in terms of policy rates.
What are you looking forward to for the economy in 2025, no matter who is president and no matter who controls Congress?
Well, I mean, certainly the jumping off point in late 24 is looking pretty favorable. Inflation's down quite a bit. We're not back to 2%, but we're getting close. The labor market's in pretty good condition. So I think, if the Fed has a little scope here to ease further, I think that could, take out or limit some of those downside risks. So we think we're probably looking at right now a pretty soft landing, though. With either outcome for the election, I think the policy, the fan of uncertainty widens out as we get into next year, and certainly into late next year when we have a lot of fiscal policy decisions that either candidate or whichever party has Congress will have to contend with. So that definitely makes things a little more murky as we get to late next year.